I've got what's potentially some very positive news regarding inflation, the Bank of England base rate, and mortgage rates going forward. So before I get into that, can I please ask you to do me two big favors? Number one, can you please give this video a thumbs up or a like? And number two, can you please share it? Because this positive news might just be the news that somebody else has been waiting for. So the more people that share this video, the more people can hear the good news. If you've been eagerly awaiting some good news regarding inflation and the Bank of England base rate, then the news that's just been released is probably of vital importance to you. So you should listen up and pay attention to the next few minutes of this video. Tomorrow sees the release of the latest set of inflation data, and it would seem that if everything that we're reading in reports is correct, then this is going to be some very positive news. Got two things that I want to share with you right now. One is an article from an industry magazine this morning, and the second is a report that has literally just been released, or it's hot off the press, from the International Monetary Fund and their outlook for the UK economy. So first of all, if we take a look at this report, the Deputy Governor of the Bank of England said Bank of England on course for interest rate cut. All eyes will be on the hotly anticipated inflation data tomorrow that will reveal how close the rate of rising prices is near to the Bank of England's official target, which, as we all know, is 2%. Mortgage holders, house hunters, city experts, along with other borrowers and savers, are waiting for indications on the timing of the first UK interest rate cut this year, with some analysts predicting that they could be reduced as soon as next month. And that's something that we've been saying since the start of this year. We think the first rate cut is coming in June. Ben Broadbent, the bank's Deputy Governor for Monetary Policy, said that if the economy evolves as expected, borrowing costs could possibly be lowered sometime over the summer in response to a steep fall in inflation. Broadbent said Monetary Policy Committee's 9 members must assess how these second-round effects in domestic prices and wages change the course of inflation over the next 2 years. The consultancy Capital Economic has forecast that inflation will fall below the central bank's 2% target when figures for April are published tomorrow and drop to less than 1% before the end of the year. This underpins our forecast that the bank will cut interest rates from 5.25% now to 3% next year, rather than to 3.75% as investors expect, said the consultants. Other analysts expect inflation to bounce back above 3% before the end of the year, as persistently high services inflation and wage increases in the financial and business services industry remain high, which will feed into higher prices. Broadbent said there is a range of views across the committee on this point. In the view of rarity of events like this over the past and the associated uncertainty about the future, that's entirely understandable. Whatever the priors of its individual members, the MPC will continue to learn from the incoming data, and if things continue to evolve with its forecasts that suggest policy will have to become less restrictive at some point, then it's possible bank rate could be cut sometime over the summer. And as you all know, earlier this month, the MPC voted 7-2 to leave interest rates unchanged at their current 16-year high of 5.25%, with Broadbent one of the 7 members who opted for no change. The money markets currently indicate that there is a 57% chance that rates will be lowered to 5% at the bank's next meeting in June, while a cut by August is almost fully priced in. Now, this is all positive news, and it's been leading us to believe that there could very possibly be a cut in June, as I said, which is something that we predicted at the beginning of the year. Now, this was an article this morning, but we've just had the International Monetary Fund live on Sky News talking about what they see for the UK economy going forward. Let's have a look at that report. Now, I'm not going to go into this in a huge amount of detail. I'm just going to cover off some key points because it is quite a long report. But if you are watching this on YouTube, then there will be a link to both articles in the video notes. So please, if you're watching this on any other platform other than YouTube, please go over to YouTube and take a look at it there, because you can read the reports for yourself. The UK economy is approaching a soft landing, with a recovery in growth expected in 2024, strengthening in 2025. Growth was 0.6% in 2024 quarter one, marking a stronger than expected exit from the technical recession in the second half of 2023, which left full year growth at 0.1%. Real GDP growth is now forecast at 0.7%, a slight upgrade from the 0.5% in the April report, before rising to 1.5% in 2025 as disinflation buoys real incomes and financial conditions ease. Moving down to point 2, disinflation has advanced faster than expected, though services inflation and wage pressure remains elevated. And this is the thing that's causing that unease about when does that first rate cut happen? Because inflation could well drop to below target when it's announced tomorrow, but there is the worry that it could go back up again. And as I've said repeatedly, what the Bank of England don't want to do is reduce rates too quick, only to have to put them back up again. So they've got to monitor things very, very carefully. It's a fine balancing act. Headline and core CPI inflation stood at 3.2% and 4.2% year on year, respectively. in March, having declined rapidly due to stronger energy and imported goods price deflation and the impact of restrictive monetary policy. Moving down to point 3, risks to growth and inflation are balanced. Inflation could be lower and growth higher if favorable second-round effects from falling energy prices are stronger and permit earlier and larger rate cuts. Inflation and growth could both be lower if domestic demand does not pick up as expected and the savings rate remains elevated. Wage pressures could be stronger, which could cause services inflation to stay elevated for longer. Inflation could be higher and growth lower if deepening geoeconomic fragmentation and/or intensification of regional conflicts like in the Middle East materialize. A shock to UK sovereign risk premium can also not be ruled out in the event of systemic financial instability at the global level. The key downside risk to growth over the longer term is that investment and labour productivity do not pick up as forecast, and labour supply disappoint due to higher inactivity, lower immigration, and/or stronger aging effects. Bold implementation of ambitious growth-enhancing reforms and AI adoption present upside risks. Then moving on to the monetary policy comment. Monetary policy has reached the inflection point, and the Monetary Policy Committee has appropriately shifted to neutral forward guidance since February. With the bank rate more than 2 percentage points higher than staff's estimate of the neutral rate, the next phase of monetary policy is to ease, and the question is when and how fast to cut rates. In this context, the MPC has highlighted the need to see through regulated energy price base effects and wait for clearer signs of receding inflation persistence to guard against the risk of premature easing. At the same time, there is a risk of delayed easing. Keeping bank base rate constant as inflation and inflation expectations fall would raise ex-post real rates, which could stall or even reverse the economy's recovery and lead to an extended undershooting of the inflation target. Staff's recommendation of about 50 to 75 basis cuts in 2024 is aimed at balancing these risks. And this is what we've been saying. Andrew Bailey pointed this out when he spoke to the press after the last meeting, and he said, we think that there might be more than 2 base rate cuts this year and that the markets have got it priced incorrectly. So this is all positive news, and it looks set to be a very positive second half of 2024 and going into 2025. So if you're in need of a mortgage, be that a remortgage, you're looking to move home, or you're purchasing for the first time, now really could be the right time to start looking into your options. Because despite the fact that rates might fall, once things do start to shift in a more positive direction, the market is going to change very quickly from a buyer's market, which it is right now, to a seller's market, when we may then start to see property prices increasing. So what do you think? Is this good news? Are you happy to hear this? Or do you think it's all smoke and mirrors and perhaps the Bank of England are just going to continue along the path that they've been treading along for quite some time? Please do let me know your thoughts in the comments. And of course, any other interaction is always appreciated.